So in this video we're going to take a look at an important role in financial markets, one that is a little bit hidden to the average retail investor, but nonetheless gets quite a lot of press comment, particularly as Eurozone debt problems start to emerge, and that is the clearinghouse. Now, clearinghouses, as I say, are a slightly hidden role. As an average retail investor, you'll only hear about them really when things go wrong, in a way, or they change the rules and cause one or two of the major players in the market, the big banks, to sort of panic a bit. So, what do? Where do they fit in? And what causes the panic that we've seen in the last couple of weeks as the Eurozone bond crisis unfolds? Okay, so clearinghouses basically fit in here. Now, if you are a broker, for example, and you have a lot of clients wanting to buy shares. So imagine you've got lots of retail clients all wanting to buy a similar share, you've got institutional clients giving you buy orders. What you might do as a broker is group them together, it's called aggregation. So you've got a nice juicy big order, because you don't want to pay, as a broker, commissions to the stock market too often. So you get a big juicy buy order, aggregate lots of small ones together, and then you go shopping. You think, right, I need to fill this order, where am I going to go? And the place you go normally to do a big deal as, if you like, a professional, a stockbroker, is the London Stock Exchange. You don't have to, there are other exchanges, but that would be a good place to start shopping. And the point about stock exchanges is that when it comes to doing a deal, to buy or sell shares, that's where you would typically go. So stock exchanges are associated with deals being done. And for anyone who's not sure about the role of an exchange, I do have a separate video explaining what is a stock exchange. So that could be useful background to this one. I'm going to keep it fairly short for this particular video. Okay? And for anyone who wants the wider context still, there is an introduction to financial markets available in my series as well. Okay, so a stock exchange is a place where people deal, and the stock exchange might employ people to shout at each other and wear colourful shirts, like in New York, might ring bells, or it might be silent and electronic, like it is in London, but the job is the same. Basically, the stock exchange is matching buy and sell orders and trying to get deals matched at the best possible prices. Buyers trying to buy as low as possible, sellers obviously trying to sell as high as possible, and the stock exchange bringing them together in a big marketplace. Okay, so that's not today's video, that's not a clearinghouse. So what is a clearinghouse? Well, here's a problem. Now, anyone who's bought a property will know about this problem. You go out and look at a property, you agree a price with the seller, and then it can take months to get your hands on the front door keys. Okay, so the gap between doing the deal and owning the property can be months. Well, in the stock market, you'll be glad to know it's not months, but it is a few days, and they're trying to close the gap over time. So normally it takes 3 working days between agreeing a price, if you're the buyer, and paying for the shares. Okay, and that creates a risk, and the risk is that it all goes wrong. All right, what if a buyer doesn't pay up? What if a seller doesn't deliver shares, or somebody suffers? So enter the clearinghouse, which suggests there is a role called clearing, and it's done, not surprisingly, by a clearinghouse. Now the sort of names here, these are not household names, to be honest. London Clearinghouse ClearNet is a good example. That's 2 that got together and merged. All right, but not the sort of thing that you see in the press every day, but nonetheless a vital role, because they provide a guarantee. And it's a very important guarantee, and we'll see how they do it in just a moment. They basically say as soon as a deal is struck at the London Stock Exchange, they step in and guarantee it. In other words, they say although there's a gap between the deal being done, that's the price and the number of shares being agreed, and actual legal entitlement to them, because shares are re-registered in the name of the buyer, although there is a gap, we'll make sure nothing goes wrong. In other words, if the seller doesn't deliver the shares they've promised, here, we'll deliver them. If the buyer doesn't hand over the cash on the right day, we will. And that's quite a big promise to make. It's an important one. It boosts the number of deals that get done, because without that guarantee, people might not trust the stock exchange, or they might not be prepared to do anonymous deals at the London Stock Exchange. So that guarantee is quite important, because it enables people to trade facelessly without revealing who they are at the stock exchange. It's quite attractive, and also it encourages people to come to the stock exchange. Now, before we talk about that in a bit more detail, and that's today's video, there is a third role, which I'm not going to talk about much in this video, called settlement. And that's where you actually get it's done electronically these days, legal title to the shares changed, because shares have to be legally re-registered like property, so that means that the seller's name's got to come off a register somewhere, and the buyer's name's got to go onto it, and the cash is actually moved from the buyer's bank account to the seller's bank account via the clearinghouse. Okay? And there are organisations that do that. One of them is called Euroclear Crest, but I won't talk about that in today's video. Just be aware that there's a 3-stage process, and of course if you're wondering why you pay your broker $9.99 per trade, it's because they have to pay for that bit, and that bit. Probably doesn't cost them $9.99 per trade in total, but nonetheless in principle that's what you're being charged for. And here's the point: when do you, as a retail investor, ever see these organisations? The answer is you don't, because you just ring your broker and say, buy me 1,000 Tesco shares. But the broker's then got to worry about where he gets them from, whether there's any risk of the trade failing, and also re-registering legal title and all that kind of stuff. So, how do clearinghouses offer this central counterparty guarantee, as it's known? How can they promise that nothing will go wrong? Quite a promise to make. Here's the answer. Okay? What they do, now I'm not going to get too techie about this, you'll be glad to know. What they do is they step in between the buyer and the seller and take over the entire contract. So imagine, normally, you'd expect, if I was buying 1,000 shares from you this morning, you'd expect it to be a simple contract whereby I pay you cash at some point, you deliver shares, and everybody's happy. Okay? What we're saying is, the way the markets organise things is, yeah, that is going to happen eventually, but basically what the markets do is they say, well, the deal at the London Stock Exchange needs to be guaranteed by somebody. So London Clearinghouse, let's use that as an example, LCH, London Clearinghouse, ClearNet to give it its full name, breaks the contract the moment the terms are agreed at the exchange, and it becomes the seller to every buyer. This is what they mean by a central counterparty, and the buyer to every seller. So for lawyers out there, that's a process. Breaking a contract like that is known as novation. Not going to worry about that too much, but basically they step in to create two contracts where there was one. They literally divide it in two. So now what they're saying is, actually, you're dealing with us now. So the seller will be delivering shares to London Clearinghouse, all right, and negotiating with them if it doesn't work out, or being sued by them if it doesn't work out, or whatever. Over here, the buyer has a deal with London Clearinghouse, all right. They no longer care who that person is. They'll never see that person, never meet that person. They may not even know their name, all right, because they know the deal has been taken over automatically by LCH, and if something goes wrong, the contract's with LCH. So, quite a promise they're making here. Whoever these people are, and they're set up by the city for the city, okay, whoever they are, that's quite a big promise to make. When you think of the millions of shares that are transacted every day, and they're stepping in and guaranteeing both sides of every single contract. How do they do that? Well, here's the answer. It's something called margin. And I will be taking this on in another video. It doesn't just apply to share transactions, it applies to bonds, derivatives, all kinds of other stuff. But here's the principle. What they do is they say, in order to provide the guarantee, okay, to both sides of the contract, both parties to the contract, we need a deposit. The moment you strike a deal at the London Stock Exchange, okay, to buy or sell shares, we want a deposit. Now the deposit is not the full value of the contract. Okay, we're not that suspicious that people won't deliver or honour their promises. We want a proportion of the value of the trade on deposit with us until the whole thing's wrapped up in 3 working days' time. And then both of you can have your deposits back, plus a bit of interest. All right? So they take a deposit. Now the amount varies, and I'll get into that in another video, but let's call it 10 to 15% of the value of the contract, say for 1,000 Tesco shares, has to be put up front on deposit in an account held and organised by London Clearinghouse. And as long as the buyer ends up paying the full amount after, say, 3 working days, and the seller delivers all the shares they promised, then those deposits are returned. All right? Now, why would they only take a proportion of the value of the contract? Why not the whole whack? Well, in part, it's because only certain people can join the club and become sellers and buyers that use LCH. All right? In other words, the likes of Tim Bennett won't be let in. I don't trade often enough, I'm not big enough, I'm not important enough, and I don't want to pay the fees. Okay? But stockbrokers, the Charles Stanleys of this world, the Goldman Sachs, the Barclays, for example, might become a member, so that they can trade big volumes at the London Stock Exchange and have those big deals guaranteed by London Clearing House. Okay? Because it's a risk business we're talking about here, so really this central counterparty guarantee only applies really to sort of big trades in terms of risk of non-delivery of cash, non-delivery of shares, and therefore membership tends to be restricted, like it is at the London Stock Exchange, to a list of eligible institutions, they're called, but that just means firms that have met the membership criteria. All right? So London Clearing House reduced their risk by only letting certain people join. They then decrease it further by taking this thing called margin up front, which is refundable once both sides have honoured their part of the bargain. Now, I'm going to finish this video with a quick mention of the Italian bond market. Where do you see these people in the newspaper? The answer is day to day you often don't, but Eurozone debt woes are throwing them into the news more often than they would be normally, because if London Clearing House get worried, so for example, imagine this is a contract involving Italian government bonds, for example, and there's some uncertainty about the whole status of Italian debt at the moment, then what London Clearing House can do is say, well, actually, we're a bit nervous. We're providing the central counterparty guarantee on every contract, but actually we are a bit worried about the subject of the contract. So they can boost margin requirements. And you'll see that comment made in the press. They'll say today, London Clearing House increased the margin requirements on contracts involving Italian government bonds, for example. And that means they're saying, well, the percentage you put down up front is no longer 5, for argument's sake, it's 10 or 15. And that creates a bit of a cash flow headache for the people who use London Clearing House, because suddenly they've got to put down a lot more cash up front than what they were normally expecting. And the effect of that can be to put people off trading the contract. It can actually reduce the number of trades that go through the market on that particular contract, and that's known as reducing liquidity in the official jargon. Okay? And it's there that you're most likely to come across London Clearing House ClearNet in action.